All right, so this is an examination of how we convert in example 5 from your problem 14 module set. We've gone over this before, but I just wanted to make a video of it so that you can review it, you can kind of clarify any issues that you had in converting between these perpetual periodic methods. Because notice, of course, this is what we worked in class, where we talked about how to lay out the FIFO periodic gross method entries. We're using the periodic accounts, purchases, freight in, purchase returns, purchase discounts, right? So all of those periodic accounts are used and we track them because we're going to need them in order to report the cost of goods sold for the period. We're going to have to close those out, all of the contra and the adjunct accounts. We close out beginning inventory with a credit. And then by our physical count, which we established in the problem at 8,000 units, that was our physical count of inventory units. Well, we then use the cost flow method, which in this case was FIFO, to determine what these 8,000 would be. And because it's FIFO, we assume we sold our oldest inventory. So this 8,000 would have to come from our most recent purchases. In this problem, the most recent purchases that we have title to because of the FOB terms would be the ones at $14, given a 2% discount. It'd have, bless me, apologize, 40 cents of freight attached to each one, which gives me a per unit price of $14.12. Multiply that by 8,000. This is what establishes my ending inventory at $112,960. So we just debit that account for $112,960. That gives me my inventory debit entry, right? I was closing the beginning inventory with a credit. That made it 0. Then I can just automatically establish this ending inventory balance after determining what it should be based on the physical count of units. The 667,280 is cost of goods sold. We could get that one of two ways. We could look at this because this is the final piece we would plug in. It's the final piece we would plug in because it is what we're solving for with the periodic inventory equation, where we start with beginning inventory, add our net purchases. Remember, net purchases are just our adjunct accounts added together, purchases and freight in. Subtract our contra accounts from those, purchase discounts, purchase returns. That would give me net purchases. Adding those with beginning inventory gives me goods available for sale. And then having that physical account to subtract from goods available for sale. Remember, periodic just assumes if we had it available and it's not in our warehouse at the end of the period, then we must have sold it, right? So it assumes that anything that is not there is sold, which is not necessarily an airtight assumption because inventory could spoil, could be wasted, it could have been stolen. So periodic will include all of those items in cost of goods sold, whereas perpetual will not. So those are some of the concerns that we have moving into the perpetual system. Now, other than that, the perpetual system, remember what each of these affects. So perpetual versus periodic, this is going to affect really two things. Primarily, it affects the accounts used to record inventory. So under the periodic system, we have the 2 adjunct and 2 contra accounts, purchases, freight, purchase returns, purchase discounts. Under the perpetual system, we use inventory every time. The second thing this changes is when we record cost of goods sold. Remember that under the perpetual system, under the periodic system, we do it once at the end of the period, whereas under the perpetual system, we have to update cost of goods sold and inventory anytime a sale is made. Gross method versus net method, this will change the dollar amounts. Of inventory transactions. So while the perpetual and periodic change the account titles, the gross versus net method changes the dollar amounts that I put in any given transaction. For example, this is a gross method. We record purchases at full price. But if this were the net method, then we would take the discounted price of those purchases. We would act as if, we would record this as if we were going to take the discount. And then FIFO versus LIFO versus average cost tells me what is the price to assume for each unit sold. So this will affect how I price the units that I sell. Did I sell the oldest purchases first? Did I sell the most recent purchases first? Or was it an average between them? Understanding what each of these affects and then thereby knowing what it won't affect really will help you guide you through the problems and understand when things need to change and when things can stay the same. So in that vein, if we look at converting this problem from periodic to perpetual, our goal really is twofold. We need to think about the accounts that we used to record the inventory, and then we also need to consider when we need to record cost of goods sold. So I've already starred the accounts that will change under a conversion of periodic to perpetual, right? Purchases, that's an adjunct account, that changes in both cases. Freight in, also an adjunct account, that changes. Purchase discounts accounts will change. Purchase returns change, and this freight credit to freight will change. All of them shift to inventory. So I could rewrite all these journal entries: debit inventory, credit accounts payable, debit inventory for freight, debit inventory instead of freight, credit cash, debit accounts payable, credit inventory for the return. So I could rewrite all that, but I think it's far simpler to just evaluate the impact by thinking about what would happen to this inventory T account that I'm keeping track of on a perpetual basis, right? Because that means anytime I purchase or return or have a cost I need to add to the inventory, like freight, then I need to add it into this T account here. So instead of debiting purchases, I would debit inventory. But first, I need to make sure that I record my beginning balance of inventory, which would be the same under periodic or perpetual method. It's $130,000 given by the $130,000 given by the $13 per unit items that I had in my beginning inventory, and there was 10,000 of them. So that doesn't change. Now I want to add to that the $450,000 that's recorded with purchases. And just going chronologically, I would add to this T account as well the $9,000 of freight, because that would be recorded as a debit to inventory instead of freight. The purchase discount, that would reduce my inventory, because remember, I want to record inventory at cost. So if I take a discount from this $450,000 amount, it should reduce the value of my inventory because I paid less for it than $450,000. Remember, I recorded this under the gross method. So when I take the discount, I subtract it out. Now moving to this next column in chronological order. Oops, sorry. I almost avoided my number 2. When do we record cost of goods sold? So at this point at 310, this was the purchase right before on 314, according to the problem, we sold 35,000 units. And we're working under a perpetual FIFO basis. So the first thing I go to is the 10,000 units that I began with, that beginning inventory. They were at $13 a unit. And that gives me, of course, 130,000, as we've seen already in the T account. So those are all gone, but I still need 25 more. And so that remaining 25,000 is going to be taken from that first purchase, these purchases that started on March 6th, added the freight, paid within a discount. So these are the guys that we're now selling. It was $15 per unit at the full price. But since we took the discount, that reduced them to 97% of that amount. It was a 3% discount. And then we're going to add in the 30 cents of freight to each item. That comes out to a total of $14.85 per unit. Multiply it by 25,000, and I get 371,250. Right? That means that on 314, I need to record cost of goods sold. My cost of goods sold is these two amounts added together because this is the total price of the inventory that I moved. And the cost of goods sold entry is this simple under the perpetual method. I just debit COGS, credit inventory for the appropriate amounts. Adding those two together gives me 501,250. I update my T account because it is the perpetual system. I need to perpetually keep the inventory account updated. Right, and then we can move on to the next batch of purchases. Before I do that, yes, this is the cost of goods sold entry. We would also have a sale entry at 314 because I did sell 35,000 units, but I don't have a cash price to that. So maybe it's cash that we got for those units, those 35,000 we sold. Maybe the customer bought them from us on credit. And that would, of course, be sales revenue. And what we would record, of course, would just be the dollar value of the sale price and multiply that by the 35,000 units sold. Make sure that you understand that that the sale would be recorded. Some people have asked about that, like, when I record a sale here too? And I'm like, absolutely. I just didn't give you information about the sale price, so you really can't give me this entry. But yes, for like completion's sake, putting the whole picture together, when I sell, of course, I'll get some sort of an asset, whether that's cash or accounts receivable, and I will get to record revenue if I deliver the goods. I've done the work, I can realize it, I record the revenue. This is the match to the revenue I just recorded. So now moving on to that next purchase. The purchases, instead of purchases, of course, I would use the inventory account as a debit under the perpetual system. So I'm going to record $210,000 of a debit to inventory. For my freight in, it's $6,000. Then I need to record a $6,000 debit to inventory because we won't have a freight in account. We'll just have inventory. And the next piece is the returns. Instead of crediting purchase returns, I'm going to credit the inventory account. So instead of that, I credit 7,000 here in the inventory. And instead of crediting freight in, I'm going to credit the inventory account by 200. And finally, for purchase discounts, instead of crediting purchase discounts, I am going to credit the inventory account as well. Now, I still have one more sale I need to record, so I'm going to give myself a little space to record that. Cost of goods sold, credit to inventory transaction. But other than that, we'll have had all the items that we need. Again, remember that the reason why I'm just taking these numbers as is and not performing any alterations to them is that we did not switch from the gross method. Remember, the gross method versus net method is what will change these dollar values in each individual transaction. But since we're still using the gross method, all we switched was to the perpetual system. Then none of these will change. That's why it's making this rather simple to translate. Now, this final sale that we make after we purchase the second, in the second part of the problem, after we make those purchases in March, we're going to have a sell on 327. So on 327, we sold 10,000 units. And again, because I am using FIFO, I want to go to my oldest stuff first. So my oldest stuff don't have a beginning inventory anymore because all 10,000 of those are gone. My first purchase that I made during the month, I used up 25 of those. I assume with FIFO that I sold 25 of those, 25,000, but there's still 5,000 left in this layer. And because then these become the next oldest purchase that I made during the month after beginning inventory, I want to go to those first. So the first 5,000 that are remaining in that layer, I sold at the same price, $14.85. I don't need to redo the math because I already figured out what each unit costs considering the discount and the freight. And that'll give me $74,250. Now, all of those are gone, but I still need 5,000 more units. And so I want to take those now from the second batch of units I purchased during March, and those were at $14. They had a 2% discount attached to them, so we'll multiply it by 0.98 to get that net of discount amount and add the freight. And that would be then $14.12. That amount comes out to $70,600. And then again, I add these two pieces together in order to determine what the total cost of goods sold for those 10,000 units would be. Debit cost of goods sold, credit to inventory, 144,850 is the sum of these two amounts. And that completes that entry there. Just need to update my T account by crediting inventory by 144,850. And we finished with all the transactions that happened to inventory during the period. So this is my perpetual inventory account. And again, it is so different. It has so much more action in it than when I looked at this from a periodic. Because remember, periodic does not update the inventory account. It does not recognize cost of goods sold during the period. Whereas this puts everything into inventory and also measures, records, recognizes cost of goods sold as sales are made. Now this one comes out to $134,000, 140. After you've done the entire reconciliation of this account, that's the balance you should end up with. So that really takes care of parts 1 and 2 to represent this as FIFO perpetual gross method. Again, I could have gone through all of these journal entries and rewritten them, but instead I just showed their effect on the inventory T account, because all I would be doing is replacing various account titles with inventory, since none of the dollar values changed because I was still doing the gross method. Now, the final piece, number 3, says basically, if there is an adjusting entry needed under the perpetual method, then provide that entry. So this piece here, this amount, this is the dollar value of inventory expected based on purchase and sales. Purchase/sales data. So all this account contains is purchase transactions, sale transactions, and this is what we would expect to find in our warehouse. Now, we don't necessarily find that, and we have to project, we have to find a dollar value for what we actually found. We found 8,000 units of inventory. So again, we have to determine what our physical count amounted to, not just in units, but then use our cost flow method to say, well, given that we are pricing based on FIFO, how much does this inventory represent in dollars? So because we're using FIFO, we assume we've sold the oldest stuff first. And we've already seen that. We sold through our beginning inventory. We sold through that first batch of purchases almost the entire way. In the next sale, we sold the rest of that first batch of purchases for March, and then we started dipping into the second batch of purchases during the month. But we did not exhaust it. So it must be the case that these 8,000 units of inventory that we counted came from this final layer at 1412 per unit, which comes to a price of 112,960. And that is the amount we found on the prior part of this problem under the periodic. And that's not to be surprised because FIFO, periodic, COGS, and inventory will always equal FIFO perpetual, COGS, and inventory. Now, this is the only cost flow method that this is absolutely the case, right? It could be that you get a random shot, and I've given you a problem like this where LIFO periodic and LIFO perpetual equal each other, but that will not always work with LIFO. FIFO will, just as a way of letting you know that if you don't want to do perpetual FIFO, yeah, well, anyway, just to let you know, there's a reason why they're equal, but that won't always be the case. So we got an expected amount, and then we have what our count indicated, right? Our expected amount and our count are both using a FIFO cost flow method. So these two, without any spoilage or theft, should be equivalent to each other, but they're not. So that means that we did have what we call inventory shrinkage. We had the amount that was in our ledger for inventory, our expected amount, and then we had the amount we calculated after we did a physical count of units and applied our cost flow method. Then that's 21,180. That's the difference of those two numbers. So essentially, we're missing $21,180 of inventory, which is a pretty big loss considering we only have 134 that we expected. So it's a pretty large percent of our total remaining inventory. That gives me a loss on shrinkage and a credit to the inventory account for that amount. And the loss on shrinkage is an operating expense. It is an effect to net income. Of course, the credit to inventory reduces my inventory. I need to then update the T account here because this is an adjusting entry. So it would take my unadjusted balance of 134,140. If I credit it by 21,180, that will bring my inventory balance down to the appropriate amount of 112,960. And this would be my adjusted balance for the inventory account. So that's how that one is worked under the perpetual system. And remember, it's only under the perpetual system that I can make this comparison of what I expected to find in the inventory account versus what I actually counted and am going with. Because under the periodic system, we have no expectation. All we have is the beginning amount of 130, and that's certainly not what we're expecting to find at the end of the period after we've recorded all of the purchase transactions and the cost of goods sold. Because remember, we're not putting those into inventory under the periodic method.